Hello everyone, this is Mortgage Lender Beaver from eCash Mortgage. In our last video, we explained what an FHA loan really is. If you haven't watched it yet, you can click the video above for a quick refresher. FHA does not stand for First Home Buyer. FHA stands for Federal Housing Administration. And even though many people misunderstand the name, an FHA loan is not only for first-time home buyers. An FHA loan is a mortgage program that follows FHA guidelines. It also includes FHA mortgage insurance, which is paid by the borrower. That mortgage insurance gives the lender an extra layer of protection. And because the lender has that protection, some borrowers may be able to qualify with more flexible guidelines. Now, let's move on to the next big question. A lot of people ask,
is an FHA loan better, or is a conventional loan better?
Which loan should I choose?
Here is the simple answer. It depends on your situation. Why? Because you should not choose a loan just by its name. Before comparing FHA and conventional, we first need to look at the numbers. Credit score, down payment, income, debt, assets, home price, loan amount, and mortgage insurance. When these numbers change, the better loan option for you can also change. And before we go further, let's clear up one important point. When many people say conventional loan, they are often talking about a conforming loan. A conventional loan is a regular mortgage loan that is not directly backed by a government program, like FHA or VA. A conforming loan is a type of conventional loan that meets Fannie Mae and Freddie Mac guidelines, and also stays within the conforming loan limit. So today's comparison is more accurately FHA loan versus conforming loan. Let's start with the first borrower. This borrower wants to buy a home for $700,000, and he can make a 20% down payment. So the loan amount would be $560,000. This borrower has a credit score of 760, stable income, and enough assets. With a strong financial profile like this, he may not need the extra flexibility of an FHA loan. In this situation, a conforming loan may be the cleaner option. Why? Because with a conforming loan, if you put 20% down, you can often move forward without PMI. PMI stands for Private Mortgage Insurance. Usually, with a conforming loan, if your down payment is less than 20%, PMI may be required. But if your down payment is 20% or more, you may be able to avoid PMI. Now, let's imagine the same borrower chooses an FHA loan instead. With an FHA loan, mortgage insurance is part of the cost. There is an upfront cost called UFMIP, and there is also a monthly MIP added to the mortgage payment. So FHA can be helpful because of its flexible guidelines, but those insurance costs matter. For this borrower with strong credit, more than 20% down, and enough assets, a conventional loan may be the cleaner option. Sometimes an FHA interest rate may look a little better, but you should not look at the interest rate alone. Once you include FHA mortgage insurance, the monthly payment or long-term cost may be higher. In that case, a conforming loan may be the better option. For case 1, this is the key point. This borrower may be able to avoid PMI and may not need FHA mortgage insurance. If the interest rate is similar, a conforming loan may be the cleaner option. Now, let's look at the second borrower. This borrower wants to buy a home for $600,000, but they only have about 3.5% down payment. So the base loan amount would be about $579,000. But here is something important. FHA loan limits can be different depending on the area. So this loan amount must fit within the FHA loan limit for that county. This is something you must check when reviewing the actual loan. Now, let's look at the borrower's profile. This borrower has a credit score of 600. Their assets are just enough to cover closing costs and reserves. So this borrower clearly wants to buy a home, but they do not have a large down payment, and their credit score is not very high. If this borrower tries to use a conforming loan, there may be a few challenges. First, with a low down payment, PMI will likely be required. Also, with a 600 credit score, that PMI may be more expensive. And lastly, depending on DTI and income, the borrower may not qualify for the loan amount they want. Simply put, a conforming loan may be too tight for this borrower, but FHA may offer more flexibility with down payment, credit, and DTI guidelines, so in this case, FHA may give them a better chance to qualify. But please remember this. The reason FHA can be more flexible is that FHA mortgage insurance helps protect the lender. But in exchange, the borrower pays UFMIP and monthly MIP. But if the borrower's biggest question is, can I qualify to buy this home right now? Then an FHA loan may be the more realistic option for case 2. Now, when we look at both cases together, we can see the main point clearly. Case 1 borrower had a higher credit score, 20% down payment, and enough assets. For that borrower, a conforming loan may be the cleaner option. Case 2 borrower had a smaller down payment, a lower credit score, and a tighter qualification. For that borrower, an FHA loan may be the more realistic option. Remember, it's not about one loan being good and the other being bad. The right loan depends on the borrower's situation, because each program has its own pros and cons. One of the most common mistakes people make is looking only at the interest rate. A low rate may look attractive, but if mortgage insurance is high, the monthly payment could still be higher than expected. That's why you need to look at the full picture, not just the rate. A loan with a slightly higher rate, but lower or removable PMI, may cost less over time. So compare the interest rate, APR, monthly payment, cash to close, down payment, mortgage insurance, and long-term costs together. That is how you can see which loan option fits your situation better. Let's summarize today's lesson. First, FHA loans and conforming loans are structured differently. Second, for borrowers with strong credit and enough down payment, a conforming loan may be more favorable. Third, for borrowers with a lower down payment, less than perfect credit, or tighter qualification, an FHA loan may be a more realistic option. Fourth, you should not choose a loan based only on the interest rate. And finally, to choose the right loan, you need to compare the actual numbers. Loan terms can vary depending on your financial profile, the property, market rates, lender guidelines, and underwriting requirements. Does this feel a little complicated? That's okay. That is why we are here. If you are wondering whether an FHA loan or a conforming loan is better for your situation, contact eCash Mortgage. When we compare the real numbers, the right choice becomes much clearer. This was Mortgage Lender Beaver from eCash Mortgage. Thank you for watching.